Have you ever wondered how some of the fastest growing e-commerce and B2B businesses scale without giving up precious equity or getting bogged down in traditional debt? It's a question that plagues countless founders. They need capital to fuel their growth, from marketing, inventory, or simply manage cash flow. But the typical routes, like venture capital or bank loans, often come with significant strings attached. Venture capitalists demand a piece of your company, diluting your ownership and control. Banks, on the other hand, require collateral, extensive credit history, and can be notoriously slow. This is where Clearco, formerly ClearBank, steps into the spotlight. They built a multi-billion-dollar business by reimagining how companies access growth capital. Instead of acting like a traditional investor or lender, Clearco operates on a unique model that has propelled thousands of businesses forward. They've identified a sweet spot in the market, a place where data, technology, and a founder-friendly approach converge. So, how exactly does Clearco make money? Let's dive deep into their innovative revenue streams and unravel the mechanics behind their success. The core, revenue share agreements. At the heart of Clearco's business model are its revenue share agreements. This is their primary method of providing capital and, consequently, their main revenue generator. Here's how it works. Imagine you're an e-commerce brand selling stylish custom t-shirts. You've got great designs, a loyal customer base, and consistent sales. You know that if you could invest more in Facebook ads or buy a larger inventory, you could significantly boost your revenue. But you don't want to sell a chunk of your company to a VC, and a bank loan feels too rigid for your fluctuating sales cycle. You approach Clearco. Instead of asking for equity, Clearco offers you capital in exchange for a small percentage of your future revenue. This percentage is usually between 1% and 20% of your daily or weekly sales, depending on factors like your cash flow consistency. The repayment is capped at a predetermined amount, which includes the original capital provided plus a flat fee. This fee typically ranges from 6% to 18% of the funded amount. This pay-as-you-grow model aligns Clearco's interests directly with those of the businesses they fund. Clearco only makes money when the businesses they invest in are generating revenue. This incentivizes Clearco to fund companies with strong growth potential and provide them with tools and insights that can help them succeed. The data advantage, fueling the engine. So, how does Clearco decide who to fund and at what rate? This is where their sophisticated data analytics and AI come into play. Clearco's competitive edge lies in its ability to quickly and accurately assess the health and growth potential of a business. When a company applies for funding, Clearco integrates with their e-commerce platforms like Shopify, Amazon, or WooCommerce, payment gateways like Stripe or PayPal, and digital marketing accounts like Facebook ads or Google ads. They then leverage their proprietary algorithms to analyze vast amounts of historical data, including revenue trends, consistent growth, seasonal fluctuations, and overall sales volume. Customer acquisition costs, CAC, how efficiently a business acquires new customers through its marketing efforts. Return on ad spend, ROAS, the revenue generated for every dollar spent on advertising. Customer lifetime value, LTV, the projected revenue a customer will generate over their relationship with the business. Inventory turnover, how quickly a business sells its inventory. Profit margins, the profitability of their product or services. By crunching these numbers, Clearco can quickly determine a company's eligibility, assess its funding capacity, and offer tailored terms. This data-driven approach removes much of the bias inherent in traditional lending and venture capital, enabling Clearco to fund a more diverse range of founders, including a significantly higher percentage of women-led businesses compared to traditional VCs. The automation and speed of this process also mean businesses can receive funding decisions and access capital in a matter of days, sometimes even hours, which is a massive advantage for fast-moving e-commerce companies. The accuracy of their data models is paramount to Clearco's profitability. By precisely predicting a company's future revenue, they can set their fees and repayment percentages to ensure a healthy return on their capital advances. Beyond capital, value-added services, and network effects. Clearco doesn't just provide capital. It aims to be a valuable partner to the businesses it funds. While these aren't direct revenue streams in the same way as their revenue share agreements, they significantly enhance Clearco's value proposition, attract more clients, and ultimately contribute to their overall success and, indirectly, their profitability. Clear insights, clear valuation, clear partners, educational content, and events. While these services might not directly generate a fee for every interaction, they create a sticky ecosystem around Clearco's core offering. Businesses that leverage these tools are more likely to succeed, leading to a higher likelihood of timely and complete repayments for Clearco, and potentially even repeat funding requests as they continue to grow. This strong relationship and value add also serves as a significant differentiator from traditional lenders. Diversification and future growth. Clearco has shown a willingness to diversify its offerings beyond just marketing capital for e-commerce. They've expanded into inventory financing, SaaS and B2B funding, invoice and receipt funding. These expansions allow Clearco to tap into new markets and broaden its customer base, increasing its overall revenue potential. Each new product or service still hinges on their core competency, using data to assess risk and provide flexible, non-dilutive capital. Clearco also benefits from a network effect as it grows. The more businesses they fund, the more data they accumulate, making their algorithms even more precise. This creates a virtuous cycle where better data leads to better funding decisions, which in turn attract more successful businesses, generating more data, and so on. With that said, thanks for watching, and until next time.